Today, hope springs. The DFA Daily to the 4th of July 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour and with a touch of philosophy on the side. Before we start, a quick reminder that on Tuesday the 7th of July at 8 p.m. Sydney time, I'll be running our next live stream where I'll be updating our mortgage stress and rental stress estimates for June and also do a deep dive on investor property stress. Probably actually the key to the whole market. You can ask a question live, and yes, I will have my postcode database online, so I'll see you then. According to Roy Morgan Research, in June, 14.5% of the workforce, or 2.05 million Australians, were unemployed. This is 42,000 fewer than in May. However, this slight improvement was largely cancelled out by the rise in underemployment, now at 10% of the workforce, or 1.41 million, up 37,000 on a month ago. This means a massive 3.45 million Australians, or 24.5% of the workforce, are either unemployed or underemployed. Now that's an improvement of only 5,000 on the May data, according to the latest estimates. The workforce in June was 14,106,000, and that comprised 12,058,000 employed and 2,048,000 unemployed Australians looking for work. The workforce total is down a small 22,000 since May. 12,058,000 Australians were employed in June, up 20,000 from May, including 7,934,000 employed full-time, up 26,000, and 4,124,000 employed part-time, down 6,000. 2,048,000 Australians were looking for work in June, down 42,000 from May, driven by a fall in the number looking for part-time work, which fell 39,000 to 1,144,000, while 904,000 were looking for full-time work, down 3,000. Now bear in mind the Roy Morgan survey defines any respondent who is not employed full or part-time and who is looking for paid employment as being unemployed, whereas the ABS defines a person who has worked for 1 hour or more for payment, or someone who has worked without pay in a family business is considered employed, regardless of whether they consider themselves employed or not. And the ABS definition also details that if a respondent is not actively looking for work, for example, applying for work, answering job advertisements, being registered with Centrelink, or tendering for work, they are not considered to be unemployed. So, in the ABS series, those on JobKeeper but not working will still be counted, and those discouraged from actively looking for work won't be counted as unemployed. Hence, as Roy Morgan uses a broader definition of unemployment than the ABS, it necessarily reports a higher unemployment figure. And in addition, Roy Morgan's measure tends to be far more volatile, actually, owing to the fact that it draws on a smaller sample than the ABS and isn't seasonally adjusted, but I think they are nearer the truth in my book. The ABS released their most recent retail sales data, and it shows that the gradual easing of social distancing regulations and the reopening of physical stores bolstered retail trade in May. Retailers across a range of industries reported high numbers of consumers returning to stores, with some retailers noting levels similar to those seen in December. There were large month-on-month rises in clothing, footwear and personal accessories retailing, up 129.2%, and cafes, restaurants and takeaway food services up 30.3%, with both industries coming off very low levels of trade in April. Levels in those industries remain well below the same time last year. Food retailing was 7.2%, household goods retailing 16.6%, department stores 44.4% higher, and other retailing 9.4% higher. They all recorded month-on-month rises in seasonally adjusted terms and are now at levels well above the same time last year. Retailers reported themes of continued spend on home improvements and high demand for recreational goods. But smaller businesses are still more in the doldrums than larger ones, something which comes through strongly in our SME surveys as well. In season-adjusted terms, the results were broadly consistent across the states. There were rises in New South Wales, up 16.5%, Victoria, up 17.2%, Queensland, up 16.6%, Western Australia, up 19.7%, South Australia, up 16.1%, Tasmania, up 17.3%, and the ACT, up 12.2%, and the Northern Territory at 8.1%. And online sales contributed 10.1% to total retail turnover, down on the 11.1% back in April, as physical stores reopened. But this is still 4 percentage points higher than the 6.2% seen in May 2019. And so on to property, where the CoreLogic index is retreating, with falls in Melbourne and Perth leading the way. This week, the index dropped 0.27% in Melbourne and 0.23% in Perth, giving quarterly falls of 2.4% and 1.4% respectively, compared to just 0.91% in Sydney. And of course, these averages mask significant variations on the ground. And CoreLogic unpicked the Melbourne property market. The July CoreLogic Index results show that the Melbourne property market is the worst capital city performer since the onset of COVID-19. June marked the third consecutive fall of value across the city. This sees values down 2.3% from the previous quarter, when the market hit a record high. Data suggests that the Melbourne market has experienced a turn in its market before others. This was evident in the most recent upswing, where Sydney and Melbourne saw peak growth rates around November 2019, while other capital cities continued to see a more moderate but accelerating growth rate. Quarterly growth of Sydney and Melbourne dwelling markets over the past 20 years suggests it's not uncommon for Melbourne to outpace capital growth in Sydney or to set deeper rates of decline. The divergence is particularly evident through the 2010 to 2012 downturn, following a substantial overperformance from Melbourne during the post-GFC stimulus-fueled growth phase. The most recent upswing before COVID-19 also saw Melbourne growth rates peak higher than in Sydney. The Melbourne quarterly growth rate peaked at 6.4% compared to 6.2% across Sydney. Now, high levels of investment are also evident in the Melbourne market, which may be contributing to volatility, though this is present in Sydney too. ABS finance data shows investor lending has comprised an average 32.3% of total mortgage lending across Victoria for the past 5 years. This is higher than most other states and territories. Melbourne may not be the worst performer over the entire cycle, but just based on a snapshot view of the past couple of months. However, there are some key structural factors creating added downward pressure on Melbourne property prices. Melbourne property markets may be disproportionately affected by demand shocks in employment and migration. The latest ABS payroll data shows that Victoria has the largest decline of payroll job positions of the states and territories as a proportion of jobs at the 14th of March. Labour force conditions are particularly impactful in the current downturn, where the cash rate target and mortgage rates are at record lows. The most impacted sectors of employment are arts and accommodation and food and recreation services. And in the year to February 2020, these sectors made up a relatively large proportion of the workforce in the Melbourne inner region at 11.8%, where dwelling value declines were 2.9% in the June quarter. Furthermore, the payroll jobs data from mid-March to the end of May suggests that one of the largest portion of job losses by SA4 in Australia was across the Melbourne inner region. Additionally, the Melbourne housing market has been the most exposed to demand from net overseas migration. Over 2018-19, Melbourne had the highest level of net overseas migration at 77,369. And this accounts for 38.2% of net overseas migration to Australia. The highest volume of net overseas migration through 2019 was recorded across the SA4 region: Melbourne Inner, Melbourne South East, and Melbourne West. While the June quarter results show the current decline across Melbourne being led by the Inner East, which was down almost 4% in the period, the shock of closed international borders may be accelerating a more broad-based decline in the region. Finally, it's worth noting that in the coming months, a second spike in coronavirus across Melbourne will be an added blow to the economy and housing market. Amid this unique engineered downturn, the level of governance stringency has been the key determinant of economic performance. The longer businesses and households are subject to social distancing, the greater the impact will be on the housing market. Now, the auction clearance rates remained under a bit of a cloud, with SQM consistently reporting lower and I think more accurate results in the 40s for both Sydney and Melbourne. But CoreLogic says that there were 1,485 capital city scheduled auctions last week, returning a final auction clearance rate of 60.6%, the highest clearance rate seen since the 31st of May. So 60.6 versus 40%. Something wrong there, isn't there? In comparison, the previous week saw 1,251 homes taken to auction, returning a 59.6% success rate. This time last year, 1,295 auctions were held across the combined capitals, and a clearance rate of 62.9% was recorded. In Melbourne, a final auction clearance rate of 61% was recorded across 645 auctions last week, up from 60.1% across 558 auctions the previous week. And 1 year ago, a lower 535 Melbourne homes went to auction, recording a clearance rate of 68.6%. And there were 644 Sydney homes auctioned last week, returning a final success rate of 62.9%, and last week's clearance rate was higher than the previous week when 61.6% of the 522 auctions reported a successful result. Now, over in New Zealand, 2/3 of real estate agents think house prices will fall, according to a survey by property data company CoreLogic. The survey of users of CoreLogic's Property Guru data service, taken in mid-June, mostly real estate agents, found 63% expected prices to fall, with 42% expecting a fall now and 21% expecting a fall later after a short-term rise in prices. Another 23% expect prices to remain flat and 14% expected them to rise. Additionally, about a quarter of the respondents expected prices to drop by at least 10% this year. A clue as to why agents appear to have a reasonably downbeat view of the market can be seen by their responses as to the reasons why vendors were listing their properties, with many selling because of financial pressures. The biggest group, at 24%, were selling because they were downsizing, while another 16% were selling because they were upsizing or for lifestyle reasons, but 19% cited financial distress as a reason for new listings, while 16% of respondents said vendors were motivated by fears of price falls, and 10% said vendors were wanting to sell a vacant rental property. Additionally, when asked how demand from buyers for properties compared with pre-COVID-19, the biggest group at 43% said they thought it was lower, while 26% thought it was about the same. All in all, it's important to note that our survey was taken at one point in time in mid-June and mostly covered one audience, real estate agents, CoreLogic's senior property economist said. However, the results are still a reality check and reaffirm our view that the property market isn't out of the woods yet. Spring remains a key period to watch as wage subsidies and mortgage payment deferrals potentially wind down, and the general election possibly creates some extra uncertainty in the economy. And finally, defending the indefensible is becoming the order of the day in the superannuation and wealth management sector. It seems the boss of IOOF has rejected speculation from a Labor MP that its platform have priced customers out of using external products. Speaking to the House of Representatives Standing Committee on Economics, IOOF Chief Executive Renato Mota was questioned on the group's Pursuit platform, which operates three models: Focus, Core and Select. As pointed to by the committee's Deputy Chair and Labour Party MP Dr Andrew Lee, the Focus model, which offers access to only IOOF funds, charges fees that are around half of what Select, which includes external products, does in its suite. Doesn't that suggest that you're charging customers more if they want to have access to external products? Dr. Lee asked. Mr. Mota defended the price divergence, later going on to point out that Focus gives access to around 5 or 6 products that are managed internally, in contrast to the Select suite, which holds more than 400 funds. What we are in fact doing there is passing on the benefits associated with having a smaller menu, and IOOF is managing both the administration and the investment menu, which is cheaper to run, he said. those benefits of that lower cost structure are being passed on to the member. Having more funds to manage adds greater complexities, adds greater risk, and we do charge more. We charge in line with the market, but it is higher than what we call our mini wrap, and that is a function of us passing those benefits, those efficiencies to the client through lower prices. He would later add that the group has obligations to manage each of the 400 products available on the select menu with daily administration and consolidated reporting. This is far more complex than doing it with 6 or 7 options, he said. Those increased costs do translate to a higher price. What we would like to think is that we're giving people informed choice. But Dr. Lee had earlier pushed back, questioning if the pricing signal is consistent with pursuing the best interests of the consumer. It seems that you're charging higher fees for something that includes external products, he said. You're effectively steering consumers towards staying within your stable. And Mr. Motor also confirmed that IWF has recently commenced payments on its remediation program for fees for no service, poor documentation, and instances of inappropriate advice 18 months after it initially began a review into quality of advice at the group, and is expected to complete the refunds within the next 12 to 18 months. Mr. Motor also revealed the group had terminated 40 advisors in the last year, and a half of those for poor advice. And now here's a brief rant. As the superannuation and wealth management sector is still milking customers, providing poor after-fee returns, and in the current environment with higher unemployment, the compulsory nature of superannuation contributions anyway means savings stop. Yet the industry is still pushing for a higher mandatory level of super contribution, and this whole system benefits the financial sector through its fees, but in my view is not fit for purpose. And standing back, more generally, we do remain in difficult territory, and that won't change for some time yet. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.